Good afternoon, and thank you for joining us this afternoon as we discuss what you need to know about investing in retail dealerships. My name is Stuart McCallum. I am the automotive retail practice leader here at Withum, a top 25 accounting firm that is offering services such as tax, accounting, controller support, and consulting to dealers in more than 28 states that we're proud to say. Joining me today is Alan HAIG.
Thank you for inviting me, Stuart. Yeah, so we're a buy-sell advisory firm at HAIG Partners. I'm the president and founder. My team and I have been involved in the purchase or sale of about 540 dealerships across the U.S. We do primarily sell-side work, occasionally a little bit of buy-side advisory to private equity or family offices.
Alan has also the distinction, as I like to say, literally wrote the playbook on new franchise consolidation.
Yeah, so thank you for bringing that up. NADA asked me last year to participate in writing this book, Buying and Selling a Dealership. So I got to write down most of the things that I remember about doing that, and it's available from NADA for free. So I hope somebody will go to their archives and download it, so this work will have been worthwhile to someone else.
And then we also have Stephen Dietrich. Thank you for joining us this afternoon.
No, thanks for having me, Stuart, and good to see you, Alan. And I'm a partner with the law firm of Holland, and I'm actually located in Denver. Our firm has offices all around the country. My practice is focused virtually entirely on the automotive retail space and other sort of dealerships with heavy truck and other construction equipment. And I essentially buy and sell dealerships. So I'm not as sell side or buy side like Alan mentioned. I'll buy and sell either side of that transaction. I enjoy that. I've probably done several hundred transactions in the past and have been working with dealers for at least, from 2004 forward, and have been involved in the auto space since 1998.
And again, I will, upsell Stephen and mention that if there is a mega deal, the odds of Stephen being involved in it are much higher than not. We are very fortunate to have such a panel for today's discussion on what you need to know about investing in auto retail. Alan, first, let's go to you. There's been a tremendous amount of buy-sell activity in the space, not just this year, but over, let's say the last 24 months, including a very large group that you just closed on in the Northeast either this week or late last week. Why don't you tell us what you're seeing out there right now?
So it's a record level of activity. We've seen, I think by the end of this quarter, we will have seen 575 rooftops trade hands in 2021. That's a record high. If that comes to fruition, there are a lot of deals that are pending approval. And one of my partners, actually two of my partners, are at the closing table today. The transaction you mentioned was the Auto Fair Group, one of the largest groups in New England that we sold to the largest privately owned dealership group. But yeah, I mean, in the last 18 months, really since the chipdemic kicked in, margins exploded, profits exploded. People were concerned about higher taxes, maybe some other longer term risks. That all collided with a lot of confidence on the part of some of the leading consolidators like Lithia, Asbury, et cetera. And the combination of high profits at dealerships with strong demand for dealerships led a lot of people to say, okay, this is the time for me to exit. I'm going to get a record high value for my company. Buyers, I think, viewed it a little bit of a land rush in 2021. Some of the biggest dealership groups in the country came to market and were acquired. I think I read 4 out of the top 100 groups have been sold this year. So a lot of consolidation and still a lot of confidence that 2022 is going to be another excellent year in the buy-sell industry. So we're looking forward to be busy for the foreseeable future.
The sellers that you have, and I'm sure for every deal that comes to market, you talk to 10 dealers that don't fully go through with it. Is there a sense that people are on the fence now, or where is that pendulum kind of hanging right now?
Well, some of the better known acquirers like Lithia or Asbury, I mean, if it's a group that's in a market where they want to expand, you can be pretty confident they're going to make an offer. But they're not expanding everywhere at the same time, right? So we're in regular communication with them on many of the transactions that we think they'd have an interest in, but they don't bid on every deal that we offer. And it's difficult now to sort of know who the best buyer is going to be. For instance, the group Auto Fair that we represent in New England, we contacted a number of the larger New England dealers, but the best buyer from that business came from Florida. He's headquartered in Florida. And he came to New England because he sees there being more opportunities for him to expand there. Meanwhile, we get plenty of calls from dealers in New England or the Midwest or California now saying, what do you have in Florida? So there's a little bit of I want to grow with almost every franchise and mini markets feelings right now for the larger consolidators. But a lot of other groups are still focused on their immediate area. And they know they have the talent, the expertise to add more value to the assets that they're buying nearby, as opposed to in a different state where they're newcomers.
I hear from a lot of buyers, what's the point? Lithia, Asbury, enter some public consolidator, large private consolidator, enter name, it is going to get the call first. They're always going to outbid me. What's the point of even trying? But from what I understand, from hearing from what you're saying, is that that's not always the case. That Lithia or Asbury isn't always just going to come in, stroke a big check. That private cap dealers and investors still have a shot.
Yes, certainly depends upon the size of the transaction. If you're representing a multi-billion-dollar dealership client, the number of people who can acquire that group are, on one or two hands, right? So there's a limited number of buyers, the larger you get. But the average dealership group today is 2 stores, and average profits per store, average blue sky per store is about a little over $10 million now. So when you include real estate and everything else, you're talking about a $60 million transaction for the average dealership group, if you will. So it's appreciated a lot, but that's an amount of money that a surprisingly large number of dealers are comfortable spending in this environment. So when we go to market with an average group, something along that size, we're getting bids from mid-sized dealers and larger dealers. And often the mid-sized dealers feel like they can add more value because they're there. They understand the brands and the market. They can add people, they can tuck it into their existing group more easily. So sometimes they're outbidding the largest groups if they have scale locally.
You had mentioned.
I support that as well, Alan. I think that's an important point. I don't think it's a very competitive market. I think, obviously there's some outliers that are there, but we work with clients who are larger groups or mid-sized groups that are very active in looking at issues, and they will look at those and try to be competitive for either geographic reasons or their strategic viewpoint, and may go toe-to-toe with some of the other folks that you mentioned that you may think to stroke a check. But I would also say the folks who are perceived to stroke the check, they may have the ability to write a big check, but they still have very sharp pencils. So it may be a large number, but it's a thoughtful number. It's probably worth that. So it's not a matter of being outbid on that side of it. So I do think there's some competition at the level of wherever the value is. They're not being outbid just because they've got the money available for other reasons. So I think it's an important point to emphasize.
Alan, you'd mentioned dealers diversifying geographies, all over the place. For somebody, private equity group, investor looking to get into the industry for the first time, or perhaps a current, for example, East Coast dealer looking to go to the West Coast dealer of Florida, what strategic considerations should they be thinking about before investing 1,000 miles from home?
Well, every market is different. And years ago, I was at AutoNation, and we had a operations team that, for instance, a market president was somebody who was overseeing 10 or 12 dealerships in an area nearby. You could drive to all the stores. And what we found sometimes is somebody who was an excellent market president in Tampa, if you wanted to relocate him to Dallas, he didn't always perform as well. And it wasn't because he wasn't working or trying. It's because he just didn't know the people in the market to recruit into his stores. And sometimes he'd recruit the wrong people. So geography matters for a number of reasons, primarily, in my opinion, related to knowing local talent. So I would say for if you're a private equity firm or family office and you're interested in investing in auto retail, I would start with what's your budget you know, if you have a budget of a few $100 million, I would look for a mid-sized dealership group that's all in one area, that has an owner that's maybe looking to retire, but there's a management team below him or her, you know, a COO, a CFO, general managers that are not near retirement. And I would buy that group and seek to expand locally and get some economies of scale through that. But, you know, we also have friends that have dealership groups that don't seem to care about geography or scale. There's friends of ours here in Florida, they bought some stores that we sold in Virginia and in Pennsylvania. They're looking in the Northeast, they're looking in the Midwest. And for them, it's much more opportunistic. They feel like they have the ability to manage people from afar, and they're not really interested in economies of scale. They really think that the businesses that they're buying have upside, so they're doing that kind of shopping. But those are experts, people who've been in the business for generations. So for newcomers, I like the idea of them investing in a group that is in one market. They can get their arms around it, they can manage it more easily, and slowly grow after that.
Rural versus suburban versus urban, you know, what are your, kind of, where do you see that falling out?
It's a great question. We just marketed a Toyota store in a college town that, you know, single point market, and there was an enormous amount of interest for that business. I think we got 6 or 8 offers out of the people we went out to, and we didn't go out to a lot. Just about everybody wanted this business. And I think people viewed it as a protected business, that it's not going to be highly competitive going forward. It's going to grow along with the university town. And so there's very little downside in a business like that. But we have other people who say, you know, I only want to look at a business if it's doing $100 million in revenue or more. It's just not worth it for me to buy a business that's smaller than that, because it's still just as much work to manage a dealership that does 100 million as it is to do 30. In fact, I can hire better management at the bigger store, so it's less of a headache for me. Those stores are typically found in mid to large size markets. And I would say if you're an excellent operator, you know, I think it makes sense to buy in the metros, because you can more easily take share from more dealerships. You know, if you are a little bit more risk averse, the single point market is more protected, has better margins, lower costs, et cetera. Sometimes it's a little harder to exit, and sometimes there are fewer opportunities for you. So it's a trade-off, and it really depends upon, you know, the individual strategy.
I'm sure a question you get all the time is, what is my franchise worth? Or, you know, what is the multiple for X franchise? How are dealers arriving at values in today's market, where I heard a presentation that you gave recently, you know, profits are up substantially year over year. So is it as simple as taking an 8 times multiple from last year and applying it to today's earnings?
It's a great question, Stuart. It's a challenge. You know, before every engagement, we typically give our client or potential client a range of values so they know what to expect when they go to market. And I would say the range is grown since COVID hit. The values have definitely gone up. I think the average dealership is worth about 60 to 70% more in goodwill than it was before the chipdemic hit. There's a formula that I think some buyers are comfortable with, which is where they maybe do a 3-year average of 2 years of pre-pandemic earnings plus, you know, current trailing 12-month earnings to create a 3-year average profit, and they put a normal multiple on that average profit number. So that's one that we've seen buyers use in the past. But I would say the last 3 deals that we priced, the offers came in at the top or above the top of our range. So I think the market is still moving. I think blue sky values are still going north, even though they're at all-time high levels. And I think that that's because buyers are increasingly confident that next year is going to be another amazing year in terms of dealership profits. And it could be another year or 2 beyond that, where we have inflated margins due to a lack of supply in the market for new vehicles, which drives higher margins and lower costs for dealers. So short answer is, you know, value is in the eye of the beholder. And we're seeing people use some formulas like I just described to value stores. But in other cases, they're just saying, hey, if this is an asset that I want, the right brand, the right market, I'll pay off current earnings because it's not going to come up again in my lifetime. So some buyers are more cautious. Others are more impulsive and just saying, this is an asset. I got so much cash on my balance sheet right now. I've got I've delevered my company. I don't believe in the stock market. I don't believe in buying a lot of real estate right now. So I'm going to put my chips back in auto retail and buy a great asset if it comes my way.
One of the issues that we've experienced when addressing the auto retail market with family offices, private equity, what we'll call financial buyers, right? The Wall Street class of buyers, is they look at dealerships and they look at the all-in capital, right? Not just the equity going in, but all their debt commitments, their floor plan, any that kind of that market value invested capital. And at that level, it becomes almost unattractive, right? You and I look at a deal and it's okay, well, we can buy it for, 10 million of real estate. We can 10 million of blue, but we can leverage half of that and then floor plan, and that's all working capital. So you don't really think about it. You look at the ROI if you juice the leverage, and it's a great return. Private equity, family offices, well, they say, well, hold on, you have a $30 million floor plan commitment. You have whatever, a working capital loan, and they take all that. Now all of a sudden the ROI drops from what a traditional buyer may see as a 40% ROI. The financial guy is looking at it as 12%, and he doesn't understand what all the fuss is. Alan, Stephen, has that been similar to your experiences? And then, what are some situations where you were able to overcome that?
Well, Stephen, I've answered maybe more than my fair share. Do you want to tackle that one?
I'll certainly try. I'm sure you'll have some insight on that, but I do think, and I think the core answer to that is education. I mean, you just gave a little synopsis on the differences of the industry, and I think what we try to do with people who are just getting into the industry is to sit down and really educate them. It's an education not only how do these businesses operate, but the financial statements are different, the financial drivers are different, the inputs are different, and the way you look at the value is certainly different. So we highly encourage and try to sit down with those folks and walk through in a little bit more detail than you gave, Stuart, certainly, but those are the topics to understand. This is why this business is valuable. This is how cash is actually used. This is how value is extracted. And I think the key to the success, I think, in that situation is whether or not the individuals that are involved in that conversation are open to that education. And the people that we have found to be very successful and really pursue this industry are folks that are curious and that are willing to be educated. And I don't say that lightly. A lot of folks are very successful in what they do. So it's just a matter of how they're viewing the world and being willing to understand and learn something a little different. And it sounds simple and maybe even sounds a little insulting. But I'm the same way. Because you're not going to ask me to litigate a case. I've been buying and selling stuff for 25 years. Not long to go to court. I got to learn that stuff if I need to learn that. So it's the same on the investors. Folks are willing to learn and engage. We're going to understand that value, but it is a process. It's a bit of an education process to go through. I'm assuming both of you have probably been through that. What you said, Stuart, sounds like not something you look at a textbook, but perhaps a conversation or three that you had. I mean, just you said, I saw Alan nodding, so I know he's been through some educational conversations.
Your experiences with financial buyers coming in, Alan, Stephen, has it been positive? Or are they thankful when they finally figure out all the puzzle pieces and where they go? Or do you see a lot of interest? They come in, they buy a store, they buy 3 stores, whatever, and they realize it's not for them and they get out?
I mean, we've seen the ones that have entered have largely been successful. There are plenty of people that I've spoken with that kicked the tires and then retreated and never made an investment. Perhaps they found other better uses for the capital. But the ones who wrote checks, and I just wrote down a handful of ones that I know are active right now. I mean, Sonic is purchasing RFJ, so that's Rick Ford Jordan. So Jordan's a private equity fund, and I don't know the exact economics, but I have a feeling that they're favorable for Jordan right now, given the prices that they paid when they bought the stores versus the prices they're paying when they're selling the stores. There's another group, Open Road Capital, which has been out in the market. I believe, Stephen, is that one of your clients?
Yeah.
Yeah, I mean, they're buying a business we're selling today.
Yep.
So they're being successful in the market, and not a big group. They're kind of backing an operator on one German luxury brand in the Northeast. GPB, which is maybe the best known private equity firm that, in terms of the story at least, that entered our industry, and it got messy. But the exit that they just had with the remnants of Prime, I think they're going to get pretty much close to getting their bait back on their deal, even though they had some troubles. There are a couple of family offices backed by Redwood Capital, or excuse me, a couple of dealership groups backed by a family office called Redwood Capital. Both of those groups are highly active acquiring stores. Morgan just bought some stores, large group of stores in Florida. Hudson's buying stores in the Southeast and the Midwest. And one of our former clients, Maury's, which is backed by the Bechtel family, they're out buying stores. They just closed on some stores, and we're talking to them about another client of ours. In fact, Stephen, that's your Christmas present, is that this transaction, we're signing a letter of intent today with one of your clients, some businesses that we're selling in the Midwest. So the ones that we see that are active are gaining traction. It takes a while to figure out how to get traction in this industry. I refer to dealerships as sticky assets. They're hard to get and they're hard to get rid of. It's not a highly liquid security, and you have to kind of commit to it. And if you're a family office, you have to accept that you're going to pay more for that dealership or dealership group than anyone else does, right? I mean, it's I think family offices and private equity firms are used to bidding and paying more than other people. But the first deal you do is going to be, you know, a costly one to get you in. But once you've bought, and Stephen, I think you were part of this years ago, if you buy a group of stores and you're approved by Ford and General Motors and Stellantis and Honda and Toyota and BMW, okay, the next deal, a lot easier. They know you, they know your financial structure, they know how you're going to operate the stores, how you're going to finance the stores. That first deal is the hardest one typically. And Stephen, I don't know if you want to join in, but your audio, at least on my ears, has been a little bit muffled. I don't know if there's anything obscuring your microphone. Stuart, did you have a hard time hearing Stephen last time?
Yeah.
I will check on that, and maybe I'll dial back in. I have not moved since we started, so I don't know what's going on.
Alan, you mentioned patience, taking time. You know, if I'm an outsider, how do I build my pipeline of opportunities, right? We know the family offices and the investors that have been around for a while. They've built their networks. They now have a pretty consistent pipeline, maybe if not acquisitions, but at least they're getting the at-bats. How do I get at-bats if I'm either a financial buyer, or if I've just been in the space for a long time, you know, a traditional dealer, but nobody knows me as a potential buyer?
The answer is pretty simple. It's picking up the phone and calling people like me, you know, like you, like Stephen, people who are in the deal business that have clients that are looking to transact. I would say the people that have called me the most often in the last year, we've done business with, because we're thinking about them when we're recommending potential buyers to our clients. Like, we don't just, you know, here's 300 people, let's send out a teaser to them. We're coming up with 8, 10, sometimes one potential buyer and recommending it to our client, because there's a balance between trying to maximize the price by going to a lot of people and preserving confidentiality by going to as few people as possible. So we see the buyers that are most successful, the ones that cultivate relationships with firms like ours. We understand exactly what they want. We know that they're serious. We know that they are persistent. We know that they'll stick in a deal even if something comes up that might be a little bit of an issue. They're not casually tipping their toe in the water to see if it feels good. They're committed. So those kind of buyers are ones that I can easily recommend to a client if what they're looking for fits what we're offering. The ones where I really don't really pursue, if someone says, well, if you get a good deal, call me. All right, well, you know, given our friends who are buyers good deals, we're retained to try to obtain the best possible terms for our clients. And those are going to be obtained from people that are leaning forward, understand what deals cost, know how to negotiate a fair agreement, will take care of the seller's employees post-closing, will be liked by the factories, will understand that investments are often needed in the facilities post-closing, so that if we agree on a price, that deal is going to close at the same price. There's going to be no surprises for the buyer or the seller.
Stephen, Alan just mentioned OEM approval, factory approval. You know, anecdotally, I always hear, oh, well, that person will never be approved, right? Oh, well, I don't know, enter KKR. If they wanted to buy an auto group, they'd never get approved. You know, what happens on the kind of in the background, right? The legal teams, your wrangling of OEMs, you know, is it as simple as KKR isn't going to get approved, or X buyer isn't going to get approved, or is there more nuance to it? What kind of happens in the background?
Yeah, first of all, can you hear me better?
That's
Yes.
better.
Great. Well, good. So all the other stuff I said before was awesome, even if you didn't hear it. So to your point, Stuart, I think that it is wholly incorrect that someone is not going to be approved. I don't care how complex the structure may be. I mean, there's going to be some issues, you know, if your money is coming from some questionable sources, you know, overseas, and not that overseas is disallowed either, but they're going to want to check it, you know, the OFAC rules, those sorts of issues. But to say that you're too complicated, or, you know, it's too large of an organization, Alan mentioned the Open Road folks. They're partnering with Bain Capital. I don't know if you get a more complicated structure than Bain Capital to go through that particular process. So, you know, I as a threshold matter, whatever the investment structure is, there's a conversation to be had. And that conversation has changed in the last 5 or 6 years. I think the manufacturers have come to realize, I'm not saying they like or don't like them, but they've just come to realize it's a fact of life that there are complicated corporate structures. Even some of the current folks who are private investors, longtime investors in the space, or longtime dealers in the space, they're reorganizing their complicated corporate structures. But what the OEMs really appreciate is the willingness to engage in a conversation. And once again, I feel like I'm repeating myself here, but it's an education process. A lot of the times, especially with a financial buyer, the first step, as Alan said, the first one is always the worst to get through as you go forward. And part of that is you have to educate them on what you're doing and why you're doing it and how you're doing it and how you're running, because that also mixes with the policy of they want to have a car person who's running their dealership. And so very seldom is there a car person who's qualified in that financial investor. And so it's a dual conversation of saying, we're going to protect your brand. We're going to protect your dealerships, and they're going to be run how you want them to be run, with people you know and approve. But yet we have this financial investor that has an interest in this. And so it's not a balance, but it's a matter of what's that relationship look like. And so a lot of the conversations are really, pre-pandemic, and now you're starting to see it more, but at some level, literally sitting down and opening up your story and saying, this is who we are, this is what we do, this is how we do it, and being open and candid with them. And the real key is to have a spokesperson or spokespeople, 1 or 2 people, who are going to commit the time to get to know the manufacturer and be open to that conversation and visit with them and say, if you have a problem, if you have an issue, you're calling Jane. And Jane will pick up that call and be your liaison to whatever's behind the financial investor, and they have the ability to say yes, no, and make decisions. So no one is unapprovable, assuming they're not felons and criminals, those sorts of issues. But that's a myth, I think, that is being dispelled at this point in time. It's going to be some effort. You got to put some time and genuine, relationship building into that. But that's what it is at this point in time, as opposed to, I think, what you may have seen in the past, where it was an active desire not to allow some of these folks in, or so afraid of what they might do. I think that time has passed.
Is there, if I go out and I'm not, right, I've never been a dealer, or I am a smaller market dealer, if I have a new car franchise approval, right, if I'm a Nissan dealer, does that credential me, or at least help me in the process of being credentialed to be a dealer for other franchises? or is it everyone stand on its own?
No, sorry, go ahead, Stephen, please.
No. I mean, I think generally, if you've shown success with one manufacturer, that certainly is going to help you as you go forward. They all have their own metrics and other evaluation tools, and there may even be, some bias. Maybe someone thinks, well, if you're good at that one, I don't respect that particular manufacturer. But that's idle gossip amongst rivals, I guess, at some level. But if you show the ability to run a dealership and are successful with it, I think that is going to give you a leg up going into the next conversation with the manufacturer, and as well as also being thoughtful, saying I'm good at X and I want to get into Y, and this is how I view yours, either as the same or different, and what I'm going to do differently. So you have the skills on how to develop and run a dealership. So I think it does give you a leg up because you've been through the process. And if you're successful at it, it shows that you know what you're doing.
A term that I've heard a lot lately, ROFR, right? Are you, I guess, fact or fiction? Or is that something that, is more common or just more commonly talked about?
I think it's more common. This is dealer gossip. So I'm not positive this is correct, but one dealer friend of mine says that Mercedes is reviewing carefully, strongly, and ROFRing almost every transaction that comes along, or trying to ROFR it, because they're interested in having a certain flavor of a dealership network. I feel like if we've done our jobs well as a seller's representative, we will have found the dealer that values our client more than any other buyer. And so we've not really experienced where we enter into a contract with one buyer and we show up at the closing table and there's a different one. Now that over time will happen to us, I'm sure. And it'll feel a little weird, but for the most part, I think that the factories, it's part of the factories playing a bigger and bigger role in their distribution networks, right? That they want to see, they want to have the customer experience a certain way. They want the facilities to look a certain way. They want to have certain dealers in their mix and not other ones. And so I view it short term, a seller shouldn't really care because they're getting the same amount of money from either buyer. But I think it has a chilling effect on the value of that franchise. So for instance, if I entered into a contract to purchase a Mercedes store, and Mercedes took that contract and assigned it to some other dealer, the next time I get called to buy a Mercedes store, I'm not bidding, because the odds are they'll take it away again. And why should I spend my time? And it's embarrassing and makes me angry, that you don't think I'm good enough to buy that store. And so the first guy who gets ROFR doesn't really suffer, but the second or third or the fifth or the 10th guy, all of a sudden the value of Mercedes stores goes down because the only people willing to bid on them are the favored fair-haired boys of the factory. And they're used to waiting around and not bidding and waiting to see what kind of deal struck and then stepping in if they like it. So it's kind of unfair, not so much to the seller or ROFR, but to all the future sellers. In my opinion, factories that are active in ROFRing deals are eroding the value of their franchises in a surreptitious, kind of invisible way that's still very tangible. I don't know, Stephen, if you feel the same way, or Stuart, you're advising buyers. Have you had an experience where a buyer was reluctant to chase a deal because they were concerned it was going to be ROFRed?
Generally speaking, yes, because, Stephen and I get involved. We start billing by the hour. There's a lot of work that goes into that LOI, right? There's a lot of work. And so it's not only embarrassing, but it's costly to spend, I don't know, $100,000 just to be left at the altar and not even have to say, you don't know why you're being left, right? You're not in the loop anymore. Sorry. And that is frustrating, I think, for a lot of dealers. Stephen, are there ways to minimize the chances of a right of first refusal, on the purchase docs?
Oh, I'll give the mythic silver bullet. I'll get to that in a second, but I do want to agree with Alan. What you've said is I think it is not just fiction. I do think that there's more ROFR activity going on. I've heard the same gossip that you've and experienced a little bit on the Mercedes side of it, but I've also seen Toyota. I've seen Ford recently. I've seen GM. So much more activity, I think, in actuality. It used to be a bit of a myth. And a while ago, JLR was doing it, but they seem to have gotten out of favor of doing that for whatever reason. But it's real. I've actually involved in 4 different transactions in some way, shape, or form that the ROFR is affecting the deal, and one where it is actually blowing the whole deal apart because of an issue. So it's real out there, and which begs your question, Stuart: is there a way to be bulletproof on that or create those sorts of issues? And there really isn't. I know that there are even articles out there about this is what you can do, or there are ways to circumvent it, or whatever that may be, and certainly other of my colleagues out there will try, and you can try to structure the deal in a way to make it perhaps unpalatable, especially if you have multiple dealerships involved in real estate. There are you can do various things to try to bundle them all together, and other aspects to make it a little bit more difficult on the ROFR side of it. But I've actually, the one that I mentioned that got blown apart was a 5 dealership deal, and one manufacturer ROFR'd it, and it has created so much stress that the buyer just walked away and said, I'm not going to do it, and the seller's kind of stuck where they are, which is problematic. But there is not anything that is a surefire way to prevent that, and the main reason, just a little more education out there, is to actually try to subvert the right of first refusal is technically a violation of the dealer agreement. So a lot of the mechanisms that you certainly could work and create a disincentive, and we've gotten and seen some nasty grams from the manufacturer saying if you keep that in your contract, it's a violation of your dealer agreement. So you really need to tread lightly on being too aggressive. Could I come up with something that would create a block to not let the ROFR go through? Yes, I could structure something to do that, but it might be looked upon very unfavorably by the manufacturer. So you have to, I think, tread lightly. And if anyone tells you there's a surefire way to do it, I would strongly disagree with it.
We got a question. I don't know if you guys could see it. Seems timely. It says, have you ever heard of a seller backing out of a deal after manufacturer approval was given? That is, after the cat's out of the bag. And how often does that happen?
We've never experienced it. That feels like some serious seller's remorse, or very inflexible buyers and sellers negotiating the value of used cars. But we have some friends in Florida that entered into a contract to purchase a dealership group in the Mid-Atlantic, and as I understand it, the seller didn't like some of the terms and walked out, and now they're litigating. So that's an unfortunate situation for all kinds of reasons. But I would say, for the most part, when someone decides they want to sell their company, when they go through that process of opening up their financial records and their business to potential buyers, and most people don't have the pleasure of working with Stephen Dietrich. Most sellers or buyers, because there's just one of him. But there are many other people who represent dealers, and the agreements are written in a way that limit risk for the buyer. They also limit risk for the seller. They're not forever agreements. And, we saw some buyers disappear during the pandemic, where they just pulled their offer and says, I don't know what's happening. I can't proceed here. But usually the seller, once they accept a number, they are looking forward to seeing that number in their account on closing day. I've not seen many people have that level of seller's remorse. I don't know, Stephen, maybe in your practice you have?
I have not. If you get past the manufacturer approval process, I've not seen someone then walk, unless there's one situation, but it was a family dynamic where someone had passed and it just threw everything else into turmoil. So it had absolutely nothing to do with the deal. But other than what I'd call an extraordinarily unique situation, if you get past manufacturer approval, that contract is pretty much locked and loaded. So as long as the buyer brings the money to the table, that thing's going to get done. There's not much out. And I'm surprised in your situation, Alan. It doesn't shock me that someone's litigating, because if you get that far down the path and you walk away, you've committed a lot of resources. So we don't see it very often at all.
Yeah, thankfully we're not in the middle of that. We're just, friendly with the buyer, so we're spectating it and just kind of. I mean, again, I don't know the seller side of the story, so I can't understand what his perspective is. But it's the only one I know of where they were all at the closing table and it didn't happen, and it wasn't because of a
Yeah.
lack of approval or financing or anything that popped up in diligence. It was just somebody had a change of heart.
Yeah, that's not to say there's not often some drama and theatrics getting to that point in time, but to actually walk out of the room. I mean, and we could all have stories of people on tables or walking out theoretically of rooms and whatnot, but to actually then not get the deal done just doesn't happen.
Sticking with the agreement, in the past 2 or 3 years, I've heard more about reps and warranties than like my whole career combined. Stephen, you and I closed a deal over the summer where you had a team of attorneys involved, right? Like a full team, multiple people, right? Not just you and I working it. How has legal transaction structuring and diligence changed over the last few years? And is it due to increased regulation? Is it due to size? Is it complexity? What's driving that?
Well, I think it's part of it is size. I mean, you're starting to get to some really healthy numbers. As Alan mentioned, you could get to $60 to $100 million pretty quickly on a transaction. And while people may be willing to do that, they also then are saying, well, I want to make sure that I understand the business that's involved. And I think with some of the financial partners and even some of the strategic folks who are involved in this, they may know the business. Because one argument would be, well, the diligence function of the reps and warranties because the person doesn't understand the business, and so they're piling on a bunch of reps and warranties to figure some stuff out. Well, that may be the case in certain situations, but we're also seeing well-heeled individuals who are generational in the space, also looking for more robust agreements. And I think part of that is the size of the transaction. I think the other part of that is it is a diligence function to do that, because a lot of people think reps and warranty is really just a way to get a gotcha after the closing and use the indemnification clause to claw back purchase price. I can count on one hand the number of times there's been an indemnification claim made in one of these deals. The real driver of reps and warranties is it's part of the diligence function. And so there's two pieces to that. You can go look at the books and you get a bunch of material, but it doesn't count the same as someone telling you what's going on with their deal. And when you're spending those kind of dollars, you want someone to tell you what's happening with that. And so it's really more of a diligence function, and the indemnification or liability is more as a backstop to say, well, we just want to make sure you're not lying to us. And if you lie to us, then we're going to use our indemnification. If you think of it that way, the reps and warranties, I'm not saying they're not a pain in the ass, because they are tough and they are robust, and you have to really think about these issues. But that's one of the reasons why I think the reps and warranties have gotten, perhaps a little bit more aggressive or more detailed to try to understand the business, especially if you're buying multiple groups. How are things done, and where are those things laying, and how do they interact with each other? You have to understand, those issues. But I think that's where we're seeing a lot of the growth. Is it's hand in hand with the diligence function that's out there, and can usually be worked through relatively easily if it's thoughtful, and if you look at it that way, as opposed to you're just trying to figure out a way to adjust purchase price in 18 months. Because, like I said, I've seen maybe 3 claims of indemnification in 20 years. So it's not the driver why you ask for those reps and warranties.
You'd mentioned that it's mostly a diligence-driven item phenomena. And I think we all have plenty of dealer friends that would tell you that 30 years ago, the dealer next door said they were going to sell. They went over, they kind of shook hands right there and then, cut them a check, and then they owned a second store. You don't really hear much of that anymore. It seems like in every deal, there's diligence. I know our transaction advisory services group, we've never been busier. Never, right? We are doing a lot of transactions. I think we're going to touch 80 different rooftop transactions this year, hopefully. We'll see. We still have a couple closings still to go this year, but 80, that's unheard of. The amount of diligence behind all of them seems like stepping up on every single transaction that you have one more question that you learn to ask. And in a lot of transactions, I think, Alan, you and I have talked about this, we're seeing a lot of, I don't want to say misrepresentation, but dealers may be a little bit unsure of what the ad backs really are. They're not really sure if they personally got paid $2 million, or if the store made $2 million and they just distribute it to themselves and it didn't go through the P&L. So is it an ad back? They're not really sure what their general manager makes, so they just kind of swag a number. Oh, sure, there should be a rent adjustment because I'm paying my dad too much for the real estate. You know, Alan, you spend an exhaustive amount of time putting together your offering materials. You know, what is to the dealers out there that think they're going to represent themselves, or to buyers out there that don't have you on the other side, you know, how much work goes into making sure that the numbers are right before a team like mine even gets involved?
Okay, well, so we start with looking at the dealer statements. We don't do an audit because we assume that we're starting with the assumption that the statements are correct. In fact, in most cases, they're under-reporting profit because dealers have a tendency not to want to let the factories know what they're making, especially right now. But there are all kinds of ways where dealers are not representing their accurate profitability or cash flows. And when I say accurate, that would be the cash flow available to the buyer at post-closing. And so, you know, dealer salaries are typical add backs. Some dealers are undercharging themselves rent, some are overcharging themselves rent. Some of them have family members that are taking salaries but not performing functions. Some of them got a windfall from an insurance settlement that's not going to be recurring. So there are probably, I don't know, 20 or 30 different categories that we look at and ask about when we're putting together the offering materials. And sometimes we're selling a little bit. Like we're saying, for instance, we have a client now, he has a 10 and 15% compensation plan for his general managers, so 10 grand a month plus 15% of the net, which, you know, made sense 4 years ago. He has a number of Korean franchises, and those brands have just blown up in value in terms of the volume, the profitability of those dealerships. So 4 years ago, that probably was a fair compensation plan. Today, in the minds of most people, that's excessive. You wouldn't do that today. He's got general managers that are making 7 figures. So in our offer materials for that group, we've added back 5% of the 15%. And we said, this is, in our opinion, excessive comp, and it's not something a buyer would do if they're starting over again. Now, will all buyers agree with that add back? Don't know. That's going to be up for them to decide. But we wanted to identify it as a potential cost savings to buyers. But certainly, we're not there to fluff up and create fake profits, because buyers are going to hire smart people like you to figure out, well, the cash flow is really not here, so we can't sustain this offer. And then if we've done that, we've taken an offer that doesn't show up in the closing statement, and that's just bad business. So because I started my career at AutoNation, and a number of my partners were at AutoNation with me, or Asbury, or they were lenders, or also accountants. We got folks from Bank of America and DHG, et cetera. We have a good sense of what is a real add back and what a buyer will give us credit for. And we display that, each individual line item, what it is, where it comes from on the dealer statement, and why we've added it back. And then after each buyer receives that information, we have a call. We go over every single add back to see if they have any questions about it. And we don't have to agree on everything, but we want them to know all of the financials the way we see it, so that when they make an offer, it's an informed offer. And they're not going to find anything in diligence that's different than what it was in the offering materials. And that's really part of the point, is to sell the upside, you know, to a buyer through the offering materials, but also disclose any kind of hair, whether it's CapEx or relocations or add points or financial issues, so that a buyer is not surprised when they go through due diligence. It's going to be confirming what was in the offering materials and what we discussed with them, and not uncovering something that's a surprise to them. And therefore, they're going to come back to the seller and say, hey, you know, you didn't tell us that your add back on this piece of property was incorrect for whatever reason. You know, you didn't explain that you kept the PPP profit in there, and that's not going to be recurring in the future. So I can't pay you a multiple on profit that's going to be disappearing. So the materials spent a lot of time, and we had the pleasure of working with Stuart a couple of years ago, and he had the pleasure of working on some of this deck. So you know how much work goes into it. But the point is to help get the price up and show the value to a potential buyer, but also prevent the price from going down. Once we've accepted an offer, it's very hard for us to get the price up. It can kind of go one way. And so we want to make sure that if we get it up, it stays up by giving buyers accurate information about what they can expect to be earning post-closing.
We've had a couple of diligences lately where, trust gets lost pretty quickly when, that you say the dealership makes 4 million and you realize that 2 million of it's PPP. If you say that there's, 4 million with 3 million of add backs and, 3/4 of the add backs come back as more of a swag than actually rooted in evidence, support. And then the dealer asks, or the buyer asks for the support. And if it takes you more than a day to get the support, you start to ask those questions. We do have a question here, and this goes back to the OEM approval. For buyers that want to buy a group, right? So we'll just say there's 5 or 10 different stores across franchises. How hard is it, or what is the likelihood of getting approval from all of those franchises, right? If it's like an all or nothing, the seller will only sell all 10 or will sell you none. What are the odds of getting approval for all 5 or 10? And then we'll have a bonus round and say,
Ooh, a bonus question.
Yep, bonus. I'm a financial buyer, but I have somebody on my management team that is known in the industry.
Well, Stephen, do you want to, I could say from the marketing perspective, what we see from buyers is that if they have a question about their approvability with a specific franchisor, they just won't bid often because it's time consuming for them to go through the process and get rejected, and embarrassing. So, sometimes we're running an auction and we've talked to 8 people and we're highly confident one guy is going to be making an offer, and he says, well, listen, I'm busy on other things, I can't submit an offer. We don't really know exactly why, but having been at AutoNation, there are times where AutoNation is not eligible to buy certain franchises due to the framework agreement that they have. And so what we see is the buyers just often they remove themselves from the process if they have doubts about their ability to be approved. Stephen, I know from a legal standpoint, there are certain things that sellers can do to ask the buyer to commit that you can do this if I'm going to enter an agreement with you. I don't know what your perspective is there.
Yeah, to answer the question generally, if there's no reason to understand, it sounds like the question may have been like, if I'm like a whiteboard, don't have anything else, and I'm just getting into the space and I'm going to go out and try to buy a group, what is the likelihood of me being able to get that deal done? Assuming that all factors are equal, as I mentioned earlier, that there's no criminal issues or, issues with the capital or whatever that may be, I don't think there's a reason why you wouldn't be able to get approved across multiple franchises. It may be a little bit more of a lift of an effort to have the conversation with 5 or 10 manufacturers at the same time. I think that's part of your education process when you're thinking, hey, I want to get into this space, probably talk to some folks and figure out what are the issues that I'm going to have to disclose and talk about, or that they're going to ask about, to determine whether or not you're willing to have those conversations and what the answers to those would be. If all of those are still green and you're like, hey, let's go try this, then I think that you would be able to get approved. It might take a little bit of effort. And that may be a conversation with the seller, because some sellers are like, look, I don't want to go through, maybe it's going to take an extra month to get all of them lined up with that particular buyer, as opposed to a buyer that may already represent those, manufacturers. There might be that might be an item that Alan might look at and go, well, let's go with X, or recommend or say, hey, for all things being equal, that's an issue. You're going to have a delay of the timing on the close with this new group, because they're going to have to probably have deeper discussions with the manufacturers, and so it creates time. But if you control for that side of it, the approval should happen. And to your point, Alan, we certainly draft. If we're selling, we often will ask the question, certainly while we're drafting the documents. What is your status? What have you done before? It may not make itself into the document, but we do often get. Speaking of reps and warranties, we often ask the buyer to say, one, they've got the financial ability, especially if the numbers are starting to get big, as well as they're not aware of any reason why they shouldn't be able to be approved. And that drives that particular question. It sounds so simple. It's 2 sentences in the document, but you'd be surprised how long those conversations can be. And often they're very good conversations. What it often drives is a collaborative event saying, all right, well, how are we going to get this done? What do we need to do? The seller's going to, be our champion and those sorts of issues. So it's not a bad question, but it certainly drives. It's almost like seller diligence at that point in time.
I like inserting that, Stephen, because it flushes the issue out. It puts the buyer on the defensive. If they enter into this agreement and they give us a buyer's representation that they don't know of any reason why they can't, close, and then they get rejected. If the factory says, well, they have, stores that are weak in sales effectiveness and bad CSI, et cetera, it really gives us the ability to go back against the buyer and file a claim and get some money back, get some damages. Now, I've never seen it happen because I think buyers, for the most part, they know they have an issue. They're not going to proceed on a deal. It's just not worth their while. Most dealers I know are eating plenty of steak and drinking good wine and having nice vacations. And they don't need to chase a deal that's going to end up potentially badly for them. They want to chase a deal that they're confident is going to be successful for them. So we typically don't have issues with manufacturer approval. There's always the question about what's the factory going to do on the facilities, because that is a key item. And often the reason why we have a client is often to sell is because they're looking at the laundry list of investments they have to make in their dealership group. And they're saying, I don't really feel like spending the next 3 years and $30 million redoing my buildings. So I'm going to sell my buildings and my dealerships now and let the next guy deal with that. And so when we're representing a seller, we disclose, hey, these buildings are image compliant. These aren't. The ones that aren't, here's what needs to be done. And here's our budget for what it's going to cost to do it. Now, you may spend more, you may spend less, but we're giving the buyer some information that they can factor into their offer, so that if we disclose it to them, they make an offer, we accept it. When they go for approval, they don't really have a reason to come back to us and say, hey, Lexus is going to make us put a new facade in the building. Yeah, we told you that. That's on page 32 of the offer materials, and we discussed it. So we're not changing the price. So that's another reason why, we like to have those materials that disclose the good things and any potential hair, so that buyers are making informed offers.
Well, gents, I think that puts us right up to our time. I'd like to thank each of you, Alan, Stephen, for joining us this afternoon, and also everybody that's been in attendance today. If you have any questions for any of us, please feel free to reach out. We are all happy to be a resource to you. Thank you very much.
Thanks all.
Thank you all.